Ernest, thanks so much for your time. I mean, we knew that 2017 was a pretty rough time for most companies, but banks, it seemed, fared pretty badly as well. What I find interesting is that most of them managed to make decent profits despite the difficulty.
That's absolutely correct, Fifi. The banks have continued to be profitable in a continuing difficult environment. Our observations are that in 2017 was probably one of the more difficult years in the recent 3 to 4 years. But banks continue to be profitable. I think it is a testament to the sound banking supervision and banking environment that our banks operate in, and a testament to the measures that our banks have taken in a difficult environment.
Mm-hmm. And let's just give us a flavour. I mean, of the top 6, which banks were able to weather the economic storm better than others last year?
Well, in fact, all 6 of them have weathered the storm really well. Some of the interesting observations that we do see from the results reported by the banks are that impairments have continued to be at very low levels. In fact, credit loss ratios have been at the lowest level since 5 years ago, and that's a continuation of the trend that we've seen over the last 4 to 5 years. The other observation we would make is that revenue is under severe stress. Revenue growth is very timid and is not coming through both on an interest level as well as on fee income level. Mm-hmm. The third observation that was interesting to us is really around the cost to income ratios, mm-hmm. The efficiency ratio. Which is driven largely by a slow growth rate in revenue as opposed to an increase in costs. So what we've noted is a significant increase in the cost to income ratios for the banks in general. Mm-hmm.
I mean, the pressure to the revenue line there, I mean, do you see that changing at all this year, especially as we've got a number of new entrants entering the market? I mean, Michael Jordan has got his Bank Zero at this time, and we're waiting for Discovery to get their bank up and running. I mean, what's the outlook for revenue in a more competitive environment?
I think that's a very good observation, that there are certainly more entrants into the market. The market participants in the banking sector are widening. I think that will certainly increase competition amongst those participants. What we do think, and if we look at independent assessments of growth rates for the economy, not just the South African economy, but the African economy in general, then there is opportunity for banks to grow their revenues both from an interest perspective and from a fee perspective.
So I was talking to Mike Brown of Nedbank on the day that they released results, and he said that the reason why particularly advances to the corporate sector had slowed down was because of the freeze in independent or renewable energy projects. I mean, today's news, the fact that there's even further delay, I imagine it doesn't bode well for the big corporate side of banks in terms of their lending.
That's absolutely correct. There's been growth in the corporate sector as there's been in the retail sector, but that growth has been subdued and certainly at some of the lowest levels that we've seen recently. I think there is a lot of sentiment that drives the market. Big corporates taking a position of waiting and seeing how the economy develops, and I think that ultimately will spill through to the consumer as interest rates may decrease during the course of 2018. There may be more appetite for consumers to take on credit, and thus and corporates for that matter to invest in infrastructure spend, and thus increase earnings.
And it's obviously our banks are not operational here only. A lot of them have got operations up there in the rest of the continent.
That's right.
I mean, so we were having a discussion about mobile money, given that the rest of Africa has quite a large unbanked population. And there was a gentleman who said that, from Nomanini in fact, and he said that he sees the banking sector partnering a lot more with mobile money players, particularly in the rest of Africa, to drive financial inclusion. What's your take?
I think that's an interesting observation as well. One of the points that we note in our report is that the extent of branch networks, both physical branch networks, that is, both in South Africa and outside of the borders of South Africa, continue to decrease. So certainly talks to the point that mobile money and digitisation is a trend that we expect to see more of, not just in the recent future, but also in going forward. Digitisation is certainly a big strategy play for most of the banks, be that from a revenue generation perspective, but equally from a cost efficiency perspective.
So I take it you're expecting more banks to, launch robots like Nedbank's Pepper there.
Absolutely. I think that is something that many of the banks, if not all of the banks, are working on, and at different stages of development. It also talks to the point that you raised about increased competition, the likes of Discovery, the likes of Bank Zero, Time Bank coming in, much more digital platform-based banks which will compete with the traditional banks.
Well, we watch the space in earnest because a lot of investors are betting on this. Not excuse the pun. Well, thanks so much. That was Ernest van Rooyen, who's a Financial Services Africa partner at EY.